There's a company in California that spent $14 million last year on something that didn't exist. Not a scam, not fraud, just nothing. And their accountants called it a smart move. Welcome to the part of business school they skip. We talk endlessly about disruption, innovation, market caps that climb into the stratosphere, but there's a layer underneath all of that. A collection of problems so fundamental, so universally ignored, that most companies just accept them as the cost of playing the game. Except the cost is getting higher, and the game is changing in ways that make these problems impossible to hide anymore. This isn't about startups failing or CEOs making bad bets. This is about structural issues baked into how modern businesses actually operate, the kind that show up in every earnings call but never get explained. The kind that make experienced CFOs go quiet when you ask them directly. Let's pull that thread. Start with something simple. Inventory. Every physical product company has to deal with it. You make things, you store things, you ship things. Straightforward. Except there's a phenomenon that happens in almost every supply chain, and it has a name: the bullwhip effect. Here's how it works. A retailer sees a small uptick in demand, say 5%. So they order 8% more from their distributor just to be safe. The distributor sees that 8% jump and orders 12% more from the manufacturer. The manufacturer, seeing 12% growth, ramps up production by 20% and orders even more raw materials. Then, demand flatlines or drops. Suddenly, everyone in the chain is sitting on mountains of product nobody wants. The initial signal, a tiny 5% blip, gets amplified at every stage until the whole system is wildly out of sync with reality. This happens constantly in industries you'd think would have figured it out by now. Fashion, electronics, automotive parts. During the pandemic, it went haywire. Companies that couldn't get enough chips in 2021 canceled orders in 2022 because they'd over-ordered by millions of units. The cost? Written off, absorbed, blamed on market conditions. But inventory is just the visible part. Let's talk about something more abstract, the sunk cost problem, but not the way you've heard it before. Everyone knows the theory. You shouldn't throw good money after bad. If a project isn't working, kill it, move on. Basic rationality. In practice, almost no one does this, because businesses aren't just economic entities, they're political systems. A failing project has a team, a budget, a VP who championed it, a consultant who sold it, and a board presentation where someone promised results. Killing it means someone was wrong, and in corporate environments, being wrong publicly is worse than being quietly unprofitable. So projects limp along. They get pivoted, budget gets reallocated, timelines get extended, and the company keeps bleeding money. Not because the math doesn't work, but because the social cost of admitting failure is too high. There's a semiconductor company that spent 8 years and over $1 billion developing a chip architecture that never shipped. Everyone involved knew it was doomed by year 4, but nobody wanted to be the one to say it out loud. Then there's the problem of measurement itself. Businesses are obsessed with metrics, KPIs, OKRs, dashboards that update in real time. It feels scientific, data-driven. But here's the uncomfortable part. Most companies are measuring the wrong things, and they know it. Take customer acquisition cost, CAC. It's supposed to tell you how much you spend to get a new customer. Simple enough. But what counts as acquisition spend? The Facebook ads, obviously. The salesperson's commission, sure. But what about the engineer who built the sign-up flow? The free trial that 90% of people abandon? Every company draws the line differently, which means CAC is less a number and more a negotiation. And if your bonus is tied to keeping CAC low, you're incentivized to draw that line very carefully. Same with profit margins. Depending on how you account for overhead, R&D, stock-based compensation, and depreciation, the same company can look either healthy or borderline insolvent. Both versions are technically true. This isn't fraud, it's just latitude, and every company uses it. Now let's go deeper. Let's talk about something that sounds boring but is quietly breaking things. Technical debt. In software, this term refers to all the shortcuts, patches, and duct tape code that gets written when you're moving fast. It works, for now, but it makes everything harder later. You build on top of broken foundations, and eventually the whole system becomes so fragile that every new feature risks collapsing something else. Most big companies are running on systems held together with technical debt that's 10, 15, 20 years old. Banks still use code written in the 1970s. Airlines run on reservation systems from the 1980s. It's not because they're lazy. It's because replacing these systems is phenomenally expensive and risky. So they keep patching until something breaks. A software glitch grounds every flight. A bank can't process transactions for 6 hours. A retailer's website crashes on Black Friday. And here's the kicker. It's not getting better. It's getting worse, because every patch adds more complexity, and complexity is the enemy of stability. One estimate suggests that Fortune 500 companies collectively spend over $300 billion every year just maintaining legacy systems, not improving them, just keeping them running. That's money that could go into innovation, hiring, expansion. Instead, it's going into life support for code that should have been retired a decade ago. But maybe the most invisible problem is coordination cost. Here's a thought experiment. You have a team of 5 people working on a project. Communication is easy. Everyone knows what everyone else is doing. Now, scale that to 50 people. Suddenly, you need meetings, status updates, project managers. Scale to 500, and you need departments, hierarchies, approval chains, tools to manage the tools. Every person you add makes the organization slightly less efficient, not because people are bad at their jobs, but because coordination is hard. The more people involved, the more time gets spent aligning, clarifying, waiting for decisions. There's a term for this, Brooks' Law. Adding more people to a late project makes it later, because the communication overhead grows faster than the work capacity. And yet, companies keep hiring, because revenue is growing and growth means headcount. But past a certain point, you're not adding capability, you're adding friction. Some of the most profitable companies in the world are profitable not because they're big, but because they're small relative to their revenue. They've figured out how to grow without proportionally growing their coordination costs. Most companies don't figure this out. They just get slower. Meetings multiply, decisions take longer, the best people leave because they feel like they're swimming through molasses, and leadership blames culture or execution. But the problem is structural. The organization has outgrown its own ability to function. Now, all of these problems, inventory distortion, sunk costs, bad metrics, technical debt, and coordination drag, they compound. They don't exist in isolation. They feed into each other. A company that can't kill bad projects ends up with more technical debt. Technical debt slows down execution, which creates pressure to hire more people. More people means more coordination costs and worse metrics. Bad metrics make it harder to identify what's actually broken, so inventory gets mismanaged and the cycle continues. And here's where it gets interesting. For a long time, none of this mattered that much. If you were in a growing market with decent margins, you could afford to be inefficient. Growth covered the cracks. But we're entering a different environment. Interest rates are higher, capital is more expensive, growth is harder to get by. Suddenly, efficiency matters again. And all these ignored problems, these things that were always there, quietly draining resources, they're becoming existential. Companies that looked unstoppable 3 years ago are now doing layoffs, cutting projects, trying to do more with less, which sounds like belt-tightening. But really, it's an admission. We were spending money we didn't need to be spending. We were carrying weight we didn't need to carry. So why doesn't anyone talk about this stuff? Partly because it's not exciting. There's no TED Talk about reducing coordination costs, no venture capital for we're going to actually finish deprecating our old code base. But mostly because admitting these problems exist means admitting that a lot of what passes for business strategy is just improvisation. We're not optimizing complex systems with precision. We're making educated guesses and hoping the market gives us enough room to fix our mistakes before they kill us. And that's fine, by the way. Business has always been messier than the case studies suggest, but the gap between the story we tell, data-driven, strategic, efficient, and the reality, political, reactive, bloated, that gap is widening. The companies that survive the next 10 years won't necessarily be the ones with the best technology or the smartest strategy. They'll be the ones that actually confront these boring structural problems, the ones willing to kill projects that aren't working, to simplify systems that have gotten too complex, to measure what actually matters, not what's easy to measure. That's harder than it sounds, because it requires saying no to people, to ideas, to inertia, and organizations are very, very bad at saying no. Here's the uncomfortable conclusion. Most big companies are running on systems designed for a different era, carrying costs they don't fully understand and making decisions based on metrics that don't quite measure reality. And they're doing fine, until they're not. Because these problems don't announce themselves, they accumulate quietly. A little technical debt here, a project that should have been canceled there, coordination costs that tick up every quarter, metrics that drift further from truth. Then one day, a competitor shows up that has none of that baggage. They're faster, cheaper, more focused, and suddenly the market shifts, and all those ignored problems, the ones that were always optional, always tomorrow's issue, they become today's crisis. That California company that spent $14 million on nothing, they're not alone. Every company has a version of that story, a cost they can't quite explain, a problem they're choosing not to solve. The question isn't whether these problems exist. They do, everywhere. The question is, how long can you afford